This is Todd Jones, president of the Shasta EDC, and I'm here today with Matt Mosley, the president and CEO of Cornerstone Community Bank. And we're going to talk a little bit about what happened at the end of last week with Silicon Valley Bank and really what makes Cornerstone Community Bank more resilient. Tell us a little bit about, from your perspective as a banker, what happened at Silicon Valley Bank last week and really what makes Cornerstone different and more resilient through times like this.
Yeah, well, what I'd like to start with on that is I'll talk a little bit about Silicon Valley Bank and kind of put a little bit of postmortem on what happened there. But more than anything, it's less about Cornerstone Community Bank and how resilient we are, but it's really about community banking in general, how different community banks are from these bank failures that we saw. So Silicon Valley Bank, they recently were closed by the FDIC on Friday. And the concentrations are one of the main things that killed Silicon Valley Bank. So they were highly concentrated in the tech startup sector and venture capital. So what we've seen is as interest rates have gone up, it's put pressure on banks to compete a little bit on interest, what they'll pay as far as on deposit accounts, on interest-bearing accounts, and then also so Silicon Valley is, has been affected by that too, trying to compete a little bit to keep balances on the balance sheet. But additionally, their customers, Silicon Valley's customers, have seen their balances decreasing. So what happens is, as those businesses had lost money over months and months and months, they went through a cash burn cycle that was pretty intense. That drained liquidity from Silicon Valley Bank. And so, which in and of itself isn't that big of a deal. Banks have levers they can pull, ways that they can position themselves so that they can survive those types of deposit drawdown. What Silicon Valley Bank decided to do is they didn't have their securities pledged to a Federal Reserve line of credit. And so what they decided to do was sell their securities portfolio, their entire securities portfolio. So it was kind of
previous to the downfall.
So Wednesday, they come out with a press release that they've sold their entire $20 billion securities portfolio to shore up cash on the balance sheet. And in that, they incurred a $2 billion loss and to hit the capital. So that is a major hit to their capital position. And their plan, it was an offering for raising capital. This is Wednesday night.
Trying to raise money to short up. So sell things, raise money.
Exactly. So bring cash on the balance sheet, raise capital to offset the capital loss they took when they sold the securities. And what that did, that combination of those two triggered a panic. Because from the outside looking in, you say, well, why did you have to sell all of your securities and take a $2 billion loss? And in the capital offering, they actually did position it, couch it as, hey, we're doing this to reposition our assets so that we can take advantage of higher interest rates. But that's not the way the market took it. And that's not the way it looks, after the fact. So took the big loss. We're not able to raise the capital. And on Thursday, the venture capital firms all started pulling money out. So $49 billion went out in a matter of hours.
And Silicon Valley Bank is like a $206 billion bank, is that correct?
Yeah, at the end of 22, there were 206, 207, somewhere around there, billion. So they had $49 billion go out like that.
Of cash.
Wow. And then on top of that, they weren't able to raise their capital, and a few of these fund managers took to social media and said, hey, get your money out. So triggered a bank run. And so the run on the bank started, more liquidity was getting drained. FDIC stepped in on Friday morning, which when the FDIC stepped in and during the Great Recession, it was always Friday at the end of business. But they stepped in the morning, which is unprecedented, shut it down. So they were positioned differently. They had, like I said, they were highly concentrated on their deposits on the tech startup sector and venture capital. And those two, community banks run differently. Community banks do not invest all their eggs in one basket. And it's kind of during good times, you can make a great amount of money when you're really concentrated. But during harder times, you want to be diversified. And so community banks like Cornerstone were diversified. And so what we saw then, before I get into diversification, so then you see confidence being lacked in other banks. Signature Bank in New York, they had very similar exposure issues, and the FDIC shut them down as well. Now, that is concerning how quickly they shut these banks down, because during the Great Recession, banks were being shut down because of asset quality. These banks actually had really good asset quality. So in a matter of time, if there's not a liquidity crunch, those banks are fine. So it was actually a really good thing in my perspective that the government stepped up and said, hey, we're going to insure all of the uninsured deposits. So basically anything, the rule of thumb, it's not totally accurate, but it's close enough, is every individual is insured up to $250,000 per institution. So anybody that had over $250,000 could have potentially lost some of their money. And the government stepped in and they said, no, we're going to make everyone whole. That was the right play, because that brings assurance to the banking system, especially to some of these bigger banks. And so they made the right call there, and it kind of stopped the panic a little bit. But in reality, then you look at our bank, Cornerstone, and I've never been more proud to be running a community bank, because we know our customers, our customers know us, we trust our customers, they trust us. You can't be a successful community bank without having mutual respect and mutual trust. But also, like, speaking to the diversification now, our bank and all the other community banks out there are diversified. They don't make big bets. We don't have any crypto exposure, which is what took down another bank called Silvergate Bank from Southern California. They're actually liquidating themselves. They said, we lost big on crypto, so we're gonna basically slowly wind down our bank and give over their money back. So they were highly exposed in crypto. Community banks, Cornerstone Bank, we don't have any exposure to crypto. We don't have exposure to tech startups that need venture funding. We don't have these high risk volatile deposits. We do business with the corner market. We do business with the doctors, with the attorneys, with mom and pop. Like, we are spread through our community, and that's the way to do it.
Yeah.
And so we're at such lower risk, and so that's something that I tell people as I had a couple conversations over the last few days, and just kind of lay our cards out and show them, we're really well positioned. So even if we had some people that decided, I want to pull money out, I'm scared, we could see a big decline and be okay. We don't have something like some of these other banks do, and nor does any of the community banks around here. I don't know their entire balance sheets, but we have the core banking principles of diversification, safe bets, knowing our customers, and them knowing us.
Yeah.
So we're in a really good spot.
In general, I mean, we would know a lot of people that are obviously banking with our community banks. The economy in Shasta County, and you don't just serve Shasta County, Shasta, Tehama, Northern California, the economy is generally pretty strong and pretty resilient right now. So we know those businesses, how they're doing, and that really helps kind of shore up the strength of the community bank, just because, like you said, you know who everyone is that's banking. Yeah. We kind of know there's not a lot of really risky things going on, like the general brick and mortar type businesses that we have in our community.
Yep. And banks are in the business of managing risk, not eliminating completely, but not taking big risks. And the other piece that I think is really important is just looking at the fact, like, knowing our customers knowing us. And the other thing that has been really cool for our bank is yesterday and today, we've actually seen an influx of deposits.
Oh, wow.
Which is it's heartwarming, to know people believe in us, and they know us.
Yeah.
So but it is interesting. There's a lot of noise out there. There's a lot of people that are fearful. And the other thing that we're telling our customers is we have a program available where you can actually it's through what's called a reciprocal deposit arrangement. And we can actually provide up to $50 million of FDIC insurance for an individual or for a business. So we have customers with sizable deposits with us that are had been participating in this for years now. And it's super easy to set up. And so people that are concerned, we say, well, we'll just set you up and we'll have the reciprocal agreement set up so that way, you're at zero risk, and if that makes you feel better, we're happy to do it.
And so all accounts are insured up to $250,000, but you're saying a customer can come in and they can get that reciprocal agreement and actually increase their limit up to $50 million.
Yes.
That's a lot of money. I've never heard of that before.
Yeah, and there's not too many people that carry more than $50
million. A lot of cash in the bank account.
Yeah. So we have that set up. We've set up a few of those the last couple of days, and it's a really slick program. So that's one of the ways that we can help our customers to alleviate any concerns that they have.
What's different now than what happened back in 2008 with the bank, runs on the bank back then and all of the volatility that happened in 2008?
Yeah, it's so different. So 2008 was credit quality. So you had a whole bunch of bad loans on banks' books, and when those started turning and going bad, people defaulting, and you start unraveling the scope of the credit quality issues, loans going bad, and not having adequate capital to support those loans. And so very different now, you fast forward to today, and bank capital ratios have never been higher. So that means how much net worth the bank holds compared to their total assets and their risky assets, which are loans. The higher the amount of capital to the level of loans, the safer the organization. And our bank and any bank, most banks in the nation have really high capital ratios now, so they can sustain significant losses. Banks had very low capital ratios back then, and underwriting was way more lenient. I remember back in the early 2000s where banks were financing subdivisions to be built and offering builders 85% loan to cost for the development of land. Not even the house. They were like, oh yeah, we'll finance 85%.
Wow.
Well, in a market where collateral values or land values are increasing, it's like, oh well, if the value's just going to keep increasing, so you're going to be fine. We'll have a better loan to value position when the lots are developed, but that can't go on forever. So it's just poor underwriting. The fundamentals weren't there, and so ultimately banks started seeing these losses. And the old adage, home values always go up, was thrown out the window.
Right.
And you saw the home values just implode. And so banks had huge credit losses, and that's what led to their failures. So now, generally, banks have very good credit quality. You look at loss ratios, non-accrual ratios for loans across the board, and banks are really, really well positioned. So that can change. We could get into an economic cycle where we have credit issues, not just Cornerstone, saying like banks in general could see credit issues at some point, but I would venture to say most banks did not make the same mistakes they made leading up to the Great Recession. I know Cornerstone hasn't.
Right.
We've been very conservative with the way we underwrite loans. And so and you underwrite your best loans in the worst of times, and you will underwrite your worst loans during the best of times. So we've been in an environment of really, really strong financial position or economic times for the last handful of years. And so those loans are going to be the ones that get tested. The banks that got aggressive, wanted to loan money, lowered their standards, when we get to a recession at some point, that's where they'll be tested. But we're in a good spot at Cornerstone, and we're looking forward to getting through any of these economic cycles and showing, being able to kind of be proud of the loans we have on our books and how strong they are.
Yeah, that's great. I don't know if you can answer this question, but how do you kind of feel about the economic times right now? We've obviously been through some roller coasters over the last really 6 to 7 months, kind of a short time span. Job market's really strong still. Unemployment's very low, historically low in Shasta County, and there's still a big demand for people hiring. So, and it seems like businesses generally are still remaining profitable. So any kind of thoughts on kind of what Shasta County's market looks like in the next year?
Yeah, that's tough. I think Shasta County is positioned better than a lot of places. I'm proud that we're doing business in Shasta County, because I think it used to be said that I remember hearing things over the years like, oh, Shasta County just follows the rest of the market, they're 18 months behind, and we just don't have what the Bay Area has. We don't have the type of strength that these other areas have. And I don't believe that's true. I look at I know our businesses, at least our customers, and I look at the type of development that's going on, and I look at the core fundamentals of the businesses we have around here, and it is really, really strong. Now, nobody's fully protected.
Sure.
We're going to have businesses that run into issues, especially with this rise in interest rates.
Right.
As soon as some of these businesses have rates adjust on their loans, they're going to have a higher payment, and they may or may not be able to sustain. So there will be some level of pain. I hope that it's minimal, but you can't raise interest rates the way that the Fed has without breaking something.
Right.
And so we are going to run into difficult economic times. I know you ask 2 economists when the recession is going to be, and they're going to give you 4 different answers.
Right.
But it'll happen at some point.
Yeah.
It would be great if it didn't, but it's hard to imagine finding a way to fight this inflation without breaking a few things along the way, and maybe increasing unemployment a little bit,
right.
and maybe seeing some businesses run into some problems. But any bank that is underwriting well, you can't avoid every single loss, every single risk, but banks should be talking to their borrowers and ahead of time, even before you first make the loan, stressing the economic times, looking at what happens if rates go up by 300 basis points, 400 basis points, like we've seen. How do they sustain? And coach your borrowers on that. I know there's been plenty of loans over the last 2 years that we have passed on, and it's because we say, guys, we can't do this loan in good faith because
right.
we don't want to set you up for a position where you're going to fail. And it protects us, of course, too. But so there's going to be some pain coming, but I know it's a long way around the barn. But I also feel like Shasta County's positioned way better, and so I have great faith in how we as a whole and how Cornerstone will navigate any kind of recession.
That's great. You mentioned that it's the interest rate increase is probably going to break a few things. I've seen a few articles out there that said Silicon Valley Bank is one example of that. I know we talked about kind of high risk loans and tech startups that were decreasing their deposits, the revenue was decreasing. I mean, how much do you think interest rates, was that a big part of Silicon Valley Bank's collapse?
Yeah, there's interest rate increases played a major part of it. It's much harder to have a tech startup company get funded, venture funds, because all of a sudden, if they can put money risk-free away, the venture capital firms can invest money risk-free and get a pretty good yield, it's less attractive to go invest in a risky startup. So it's harder for those funds to be delivered. So in a zero interest rate environment, like we've had in the past handful of years, you saw tons of private equity entering the market. There was so much cash and there was nowhere to get a return.
Right.
So as that changes, there's less money flowing to these startups because rates are higher, and so they're having to borrow more and borrowing more at a higher price. So it just becomes a untenable situation for a lot of these startups. But then also kind of diving into the bond accounting stuff, which is, I know it's a little complex, but when Silicon Valley, what they did, they had a ton of excess deposits on the books. A lot of banks did over the last couple of years.
People had a lot of cash.
Tons of cash. And so banks were pressured in a zero rate environment to say, well, how are we going to get a return for our shareholders? Well, Cornerstone, we invested a lot in lending to customers that we know in our community. So I feel like we made a really great bet there. But banks like Silicon Valley Bank, what they did, they had billions and billions of dollars, and they said, we're going to buy treasuries and we're going to buy long. So what they did is the classic mismanagement of interest rate risk and asset liability funding risk. What they did is they took all these short-term deposits that could go out in any moment, and they invested them in long duration securities, 10-year treasuries, and not just 10-year treasuries, but that's an example, long horizons and at super low coupons, like 1%, which a year ago was pretty nice. 1% was, it's like, oh, cool. But
better than zero.
Better than zero. But when you bet the whole thing on that, you position your whole balance sheet, your securities portfolio as that, then what you're doing is, okay, you're getting that, we'll call it 1.5%. You're getting that 1.5% on all these billions of dollars. Well, if rates don't change, the value of your securities are generally unchanged, and you're clipping a coupon at 1.5%. But As soon as interest rates go up, the underlying value of those bonds drops.
Right.
Because then if you had to sell them, so if I'm going to sell you a bond, let's say it's $1 million at 1.5%, you're not going to pay me $1 million for a 1.5% coupon when your replacement rates out there are 4%.
Right.
You're going to pay me maybe $500,000 for that, so you can effectively get the same rate as you do an open market. So when they went long at low coupons and then rates went up, the value of their portfolio dropped, and it actually, a lot of banks got to a position where that, what they call unrealized loss, so the mark-to-market loss that they don't realize until they sell it, so they are carrying hidden losses on their balance sheet, that was enough to wipe out their capital. So there's a lot of banks out there that made those big bets thinking, well, we're going to go long on our duration, take a low coupon. Well, now they may be sitting in a place where if they had to sell their securities, it would wipe out their capital and they're no longer a business. They're bankrupt.
Right.
So where we sit, and hopefully our community bank brethren around here sit, is we didn't make a bunch of those investments. We could sell all of our securities right now and we would be above well capitalized, which is a great position to be at. But it's because we didn't make big bets. We make little bets. We say, okay, well, this is a good investment. Okay, well, we're going to hedge that, invest here, and just make sure that, because we are building this bank to be around. We're not building this bank to have a bunch of short-term wins at the expense of long-term success. We're here for the long-term, and we want to focus. You don't run a bank on the short-term. You run a bank as a legacy.
Yeah, that's great. Well, anything else you want to add? Any insight or excitement about Cornerstone in the next year, or anything else you kind of want to close with to wrap it up?
Yeah, we have exciting stuff on the horizon. We're making a major investment in digital technology, so that's going to be.
I'm excited about that.
Yeah, that's going to be incredible. Put us on just an incredible level with our technology offerings. We're investing a ton of time and resources in that. And we have seen some incredible growth at this bank. Professionally, we've recruited some incredible employees. We've seen depositors, customers come to our bank from other banks, and we've really held to the tenet of community banking, and it's been a great benefit. And I am very, very hopeful for what this year has to bring. I love what I see. I love the team that we have, that we get to work with, and if we take care of our teammates, our employees, and we take care of our customers, our shareholders get taken care of, and we'll be profitable, and we can create our own destiny. And I love the cards we're holding.